Hi everyone, let's take a look at this leverage example. Okay, I'm going to read it now. Company XYZ has an opportunity that it thinks will generate a return on investment, that's ROI, of 15% for every dollar invested from $0 to $25 million. The cost of incremental debt that it is considering using on the investment will be about 10%. So assume it's 10% exactly. The lender of the debt is willing to lend $10 million to XYZ. Now the company is also considering using its own $1 million of excess cash to invest in the project rather than incurring the debt. And then I've asked who can calculate the return in the dollar amount of increased shareholder value. That means the dollar amount that the company would be better off if it goes ahead and undertakes the project. And we want to calculate the return to the company's shareholders, ignore taxes, so before tax considerations, under each of the following alternatives. Okay, alternative A says the company invests both its $1 million that it has of excess cash and it borrows the $10 million from the bank. Alternative B says it's only going to use external sources of funds, so it will use all the $10 million that it's arranged from an outside lender. And alternative C says let's take the conservative route. We don't want to incur any debt, and let's only invest $1 million of excess cash in the new opportunity. Okay, now I've laid out the opportunity behind us, and to save time with the demo, I've actually worked it ahead of time, so I'll just bring some information to light. All right, let's go right here, and I'll say we start off with incremental investments, and the first thing we want to indicate is how much of our own funds would we use. Now in case A, we're going to use $1 million of our own funds. In case B, we're not going to use any, right? And in case C, we're only going to invest the $1 million, so let's put the $1 million there. Now, with regards to borrowed funds, in case A, we're going to use the $10 million. In case B, we're also going to use the $10 billion, but none of our own. And in case C, we're going to use none of our own. Okay, so if I total that, and all I'm using is the sum formula here, as you can see. Nothing fancy in Excel here. The total incremental investment we're talking about is either $11 million, $10 million, or $1 million. Okay, now let's calculate the expected income, which is the return of 15% that we're expecting on every dollar invested. Okay, let's see how I came up with that $165 million. I take the total dollar invested times 15%. Now in this scenario, we're going to totally ignore taxes. So let me just copy that here and here, and we calculate the various returns, right? It's 15% times the total dollars invested. Okay, now let's figure out what the income is flowing to the shareholders. $650,000 under case A. Now, how am I doing that? What I'm going to do, I'm sorry. Let me step back a minute. Once we have the expected income flowing to the investment dollars, we need to back off the interest cost paid on borrowed funds. So let's bring this to light, and what you see is we'll take the $10 million borrowed times the 10% interest cost. Again, we're ignoring tax purposes for now. And then the income flowing to the shareholders is simply the $1,650,000, the 15% return on $11 million, less what we have to pay out in interest costs. Okay, now under case B, we can do that same under case B, we have the interest on borrowed funds, which is the same $1 million, and our return then is $500,000. Okay, now we'll do the same calculation for case C. Of course, there's no interest under case C because we're not borrowing any money, so the return is just the $150,000. Okay, but that tells us the income flowing to shareholders. Now let's calculate the percentage return for the shareholders. Okay, so in case A, we simply take the $650,000, the total return that flows to the shareholders, divided by the amount of investment provided by the shareholders, and we come up with 65%. Now, in case B, it's a little bit tricky, and I'm going to show Excel here to show what I did. I think maybe if I just use the F2 would be the best way if it'll display. Oh, it's not. Okay, so let me use the formula bar, and I got a little bit fancy here. But here's what I've done. Let me put this where you can see it. First, I put in a logical test that says if D18 is 0 and D24 is greater than 0. Now, all I'm doing is putting in logic that you all can do in your head, but I thought I'd share how you could use Excel to calculate an OR type of calculation. So I've said if our own funds are equal to 0 and we have a positive return, right? There's income flowing to the shareholders, then the answer must be infinity because you have a positive return divided by 0, which will give you a divide by 0 error, as you see right there. But the divide by 0 error really means we have a non-determinable infinite return, right? There's nothing to divide it by. So I've said use the word infinity if that's the case. Now, if D18 is not equal to 0 and D24 is not equal to 0, then simply take D24 divided by cell D18, which is the same as the 65% calculation. Okay, so once I do that, we can hit enter. Let me bring that one to light. And we get, of course, the word infinity. Now, to show that really works for case A, I can copy it over it and you'll get the same amount. And then, of course, we do it on the last one. And the last one, of course, it's only the 150,000 divided by our million. Okay, so I think this is a good example of leverage. It shows that if you expect a rate of return that is higher than the cost of borrowed funds, ignoring other risks like the chance that you can't pay the money back, it illustrates that debt provides a tremendous value in terms of return to the shareholders. And that's one of the main points, or that is the point of financial leverage. We see that as much as we can borrow generates the greatest amount of return, right? 650,000 when we used our own money and someone else's. But in terms of percentage return, if we use entirely someone else's money or a great percentage of someone else's money, you see the benefit of leverage to the shareholders. Okay, thank you everyone. I hope you found this useful.